Hi, welcome back. All right, now on this one, we've already talked about how much should you buy. Hopefully you've got a good idea on what you need. Now the question is, what type of product should you buy to fulfill that need? As I'm sure you're aware, life insurance has two different types of products. We'll call them term and whole life. There are many different variations of each one of those, but let's just keep it simple for now. We'll call them term and the whole life. Now, the first question you should ask yourself is, why is there two different types of life insurance? Because with all the other types of insurance policies that you buy, your homeowner's insurance, your automobile insurance, your health insurance, your disability insurance, your E&O insurance, every other type of insurance you own, there's one kind. But with life insurance, there's two kinds. Why? What gives? I used to do a lot of public speaking, and I'd always ask that question, and never once did somebody get the right answer. They got correct answers. What they said, well, it's marketing, you get cash value, and a lot of things that were, yeah, that's true, but that's not why. My question is, why is there two types? And there's actually a very logical reason on why there's two types of insurance. The reason is, with all the other types of insurance, you're insuring a potential event. You might be in a car accident, your home might get burglarized, you might get sick and go to the hospital. With life insurance, you're insuring a known event. No doubt about it, you're gonna die. The question is just when. Two other reasons that allow for the cash value is, not only are you insuring a known event, but it's one event and one event only. Again, with all the other types, you might be in multiple car accidents, you might be in no car accidents. With life insurance, one claim only. And the third reason that there's two types is that with life insurance, it's morbid, but it's true, with each passing day, you're getting closer to that eventual claim. Whereas with the other insurances, that's not necessarily true. You could live in a house for 50 years, and if there was no fires or burglaries, that doesn't make it more likely to be burglarized or burned in the 51st year. With life insurance, if you've lived 50 years, you're certainly more likely to die, in that 51st year. It doesn't mean you will. You're likely to live to life expectancy, but you're more likely. So with that, that's why there are two types of insurance, because the actuaries can design a policy to last your lifetime. Now, the one myth that I want to dispel is, people say, well, the cash value life insurance, the whole life, it's got a savings component. That's an analogy, okay, so that you can understand it. That is really not a savings component. What that is a reserve to pay the claim. An insurance company is just like any other company, all right? Microsoft has certain expenses. They've got to pay their people. They've got real estate. They've got advertising, all these expenses. And then they've got the money from the sales. The difference is their profit. Well, life insurance companies are the same. They've got computer systems. They've got people that they've got to pay. They've got the real estate. But they've got one other expense, and that is they've got potential claims. So they've got a reserve for the claims. Now, that reserve is dependent upon how likelihood the claim is. On term insurance, people say to me, Ron, well, how come the whole life has a cash value but the term doesn't? Well, because the likelihood of paying a claim on the term insurance is very, very small. LIMRA, which is a life insurance organization, calculates that less than 2% of all death claims are paid on term insurance. That means that more than 98% are paid on permanent. Now, why is that? Well, let's get a couple things clear. First, if you die and you own term insurance, they're going to pay a claim. There's no question about it. The fact is, you're unlikely to die when you own term insurance. Why is that? Well, because term insurance will expire before your life expectancy. And in fact, they won't write it past your life expectancy. If you're a 75-year-old male, you can't buy a 20-year term policy. The insurance companies won't write it. If you're a 25-year-old male and you buy a 20-year term policy, well, most 25-year-olds are going to live to 45. Hence, you'll have the coverage, the peace of mind for those 20 years, and at the end of the 20 years, it's all over. The insurance company says, we don't want to play this game anymore. And if you want insurance now at 45, you got to go back out into the marketplace, requalify, and get the insurance. So that's why there's two types, and that's what the cash value really is. It's a reserve. And here's another dirty little secret of the insurance company. That reserve is not yours, the owners of the policy. That reserve is owned by the life insurance company. People say, but Ron, I can access it. You can. The insurance companies always make it accessible. If you cancel the policy, they'll give it to you. Why? Well, because now they're no longer on the hook for that claim. They were saving up the money to pay an eventual claim. You canceled the policy. You let them off the hook on the claim, so they're saying, we don't need this, here you go. Same thing if you don't want to cancel the policy. If you just need the money and you want to keep the policy in force, you can access the cash value via a loan. But again, it's a loan on the policy, and it's really, legally, not a lot of people know it, a lot of agents don't know it, legally the cash values are owned by the insurance company. So, that being said, what type of life insurance policy should you buy? Well, if you have a defined risk, you've got a loan that's due in 10 years, and either the lender or you want to insure it. Certainly a term policy would be appropriate then. So for temporary risks, term is appropriate. For permanent risks, risks that are not going to go away, then some type of permanent policy, a whole life, universal life, whatever, would be more appropriate. So you really got to determine what your objective is. And in most cases, it's a combination of the two. Young people, obviously it's more advantageous to buy the permanent when you're young because it doesn't get any cheaper, but it costs a lot more than the term. And if you're a young married couple starting out, you got a mortgage, maybe a kid, some debts, the term insurance is a much more practical way to indemnify yourself. But be clear that that's not a permanent solution, that will run out at some point. Now, the thing I always hear is, yeah, well, that's cool, Ron, but I'm not going to need the insurance in X number of years, 10 years, 15 years, 20 years, whatever, when I retire, or whatever. Well, I don't know how you can sit here today and tell me that with a straight face. What you could say is, if things continue to go as I plan, I don't think I'll need that insurance at some point in the future for the need that you're telling me I need it today. Because the needs change, but the insurance can still fill those needs. And what are we talking about there? Well, in one of the next videos, we'll talk about different uses of life insurance, and I'll explain it. But let's get back to the types of insurance and what you should buy. Again, the most important thing you should do is get the proper amount. If you can only afford term insurance to get the amount, then by all means, you insure the amount with term. But if you've got a permanent need and you've got some cash flow that could be utilized to solve that permanent need, then you should direct that cash flow into a permanent policy. Again, this is kind of a technical thing. If you've got questions, you can email me, you can call me. The contact information is on the homepage of the website. I'd be more than happy to talk to you and answer your individual questions. That's it for this one, and on the next one we'll talk about some different uses of life insurance.